Hello, this is Vandana, founder of Vanda Insights, a provider of oil markets macro analysis. It's the 29th of December 2022. This year is already almost out, and everybody is looking forward to 2023 and also wondering what it might bring for us. I'd like to talk to you about the oil markets. Crude prices jumped by about 40% year on year in 2022. That's true of the sweet benchmarks Brent and WTI, as well as the sour markers Oman and Dubai. Their annual price averages settled in the $94 to $100 per barrel range, the highest since 2014. Back then, crude was coming off its all-time nominal highs notched in 2012, and at the time it had continued tumbling on an annual basis before a gradual recovery took hold in 2017. This time around as well, crude is on a slippery slope. We expect the averages to drop to a range of $75 to $80 per barrel in 2023, primarily driven by a slump in oil consumption amid a global economic downturn. Now, let's talk about demand. Our outlook is based on the assumption that annual global oil demand growth will decelerate to less than 1 million barrels per day next year, after rebounding from its COVID shock by nearly 5.9 million barrels per day in 2021 and about 2.4 million barrels per day in 2022. Chinese oil consumption declined by around 3%, or an estimated 400 to 500,000 barrels per day this year, due to stringent curbs on economic activity and mobility under the government's zero COVID policy. With Beijing on a sharp pivot away from its stringent controls since early December, Chinese oil demand could reclaim all the ground lost this year and potentially more, albeit gradually. China's slow return to a new normal in oil demand may extend into 2024. Among the world's other major oil-consuming regions, we expect almost a plateau in the US and a drop in appetite in Europe next year. Indian fuel demand vaulted by about 8.6%, or 370,000 barrels per day on year in 2022. But having clambered back above pre-COVID levels, we expect the annual growth to moderate to around 3 to 4% next year, which equates to 140 to 190,000 barrels per day. Now, how about supply? On the crude production front, capacity within the OPEC-non-OPEC alliance will remain severely hampered. The inability of a majority of members to restore production to their pre-COVID levels is now a systemic supply risk, which will likely return to bedevil the market in 2024. But for next year, OPEC Plus should be able to maintain supply in line with demand. It may even decide to make deeper cuts to avoid a surplus and stock builds. Pricing power will remain with OPEC Plus as growth in major crude producers outside the group, principally the US and Canada, remains relatively modest. How about the global economy? As the US Federal Reserve and other major central banks vow to stay the course on tightening monetary policy in a bid to tame red-hot inflation, considerable uncertainty hangs around the global economic prospects for 2023. The next few months may need a constant recalibration to assess growth. The unpredictability for the oil market will be exacerbated by the challenge of correlating a present-day economic downturn with oil demand. Now, setting aside the COVID-induced GDP contraction in 2020, the last global recession was in 2009, which saw a roughly 2% annual drop in oil consumption. High inflation, which is usually not associated with a recession, and a possible long tail of the post-COVID demand rebound, which may manifest in the travel and leisure sector, for instance, even if other areas of retail spending contract next year, further complicates the picture. The International Monetary Fund in October forecasted global economic growth will slow down from 3.2% in 2022 to 2.7% in 2023. That was a third consecutive downgrade in the fund's outlook for next year. following growth projections of 3.8% in Jan, 3.6% in April, and 2.9% in July. The figure may be further downgraded in the next outlook. None of the major factors that the IMF mentioned in its last World Economic Outlook in October, namely cost of living crisis, tightening financial conditions, Russia's invasion of Ukraine, and a lingering COVID-19 pandemic, have dissipated. In fact, the first two have arguably worsened. Our base case assumption is that Russia will persist with its offensive in Ukraine at least for the next several months, and the West will maintain its sanctions against Moscow, though we don't think there is scope for them to be meaningfully ratcheted up either. Outright sanctions against Russian energy exports, like the strict US bans against Iran and Venezuela in recent years, are out of the question, we think. The energy weaponization sparked by the Ukraine war looks set to continue. Combined with the likelihood of China's supply chain crisis lingering at least for the next few months, it is hard to see any relief valves for inflation. While the EU voluntarily wound down its Russian crude imports this year, Moscow has slashed its pipeline gas exports to the bloc by around 73% versus last year's average as a retaliatory measure. Global oil and LNG trade flows are being redrawn in a big way, and it comes at a price, including higher freight costs as molecules travel longer distances between producers and their new markets. EU's switch to LNG imports and hunt for alternative pipeline gas supplies will continue. The bloc may have to fork out even more than this year's eye-watering prices for LNG if Chinese demand normalizes next year. Cross-border as well as national geopolitical risks in the Middle East, an ever-present threat to oil and gas supplies from the region, will carry through, not only into 2023, but the years to come. They stem from intractable conflicts. In the event of any substantial and protracted crude supply outages, we think OPEC Plus would struggle to plug the gap. Even in an overarching bearish demand scenario, geopolitical risk in energy-rich nations remains a potential driver of price spikes. More detail on our base case scenario for the oil markets in 2023, as well as the wild cards and the longer-term shifts worth keeping an eye on, can be found in our just published report, Oil Market Radar 2023. Thanks for tuning in and wish you a very happy new year.